Welcome to the Meb Faber Show, where the focus is on helping you grow and preserve your wealth. Join us as we discuss the craft of investing and uncover new and profitable ideas, all to help you grow wealthier and wiser. Better investing starts here.
Meb Faber is the co-founder and chief investment officer at Cambria Investment Management. Due to industry regulations, he will not discuss any of Cambria's funds on this podcast. All opinions expressed by podcast participants are solely their own opinions and do not reflect the opinion of Cambria Investment Management or its affiliates. For more information, visit CambriaInvestments.com.
Welcome back, everybody. We got a fun episode today. Today's guest is Chris Clark. Chris is a 20-year vet of the biopharma space and was a biotech PM for 10 years at RS Investments, where he created their biotech strategy and managed over $4 billion. And also, he's another UVA alum and Japanese ski aficionado. Chris, welcome to the show.
Wah wah. Thanks, Meb. Long time, first time.
This is your first podcast. Technically not your first podcast. You've recorded one, but with our buddy Patrick O'Shaughnessy. It was so inappropriate, they couldn't publish it. Is that right? What happened?
That is exactly right. Compliance started editing, and then there was nothing left to edit.
Well, the good news is today is you can say anything you want and we'll publish it. So let's have at it. So we're going to have a lot of fun talking biotech and all things investing, public, privates today. I thought a good place to start, we recently did a pod with our good buddies, Dan Rasmussen, D.A. Wallach. D.A. was talking a little bit about biotech. He had a fun conveyor belt analogy. So maybe to explain biotech sector, you want to start there?
I loved that episode. I found myself speaking out loud as I was listening to it and trying to be the fourth party in the room. And he had some great analogies, as did Dan. They were really onto something. And that's when I reached out to you that we can take that baton and carry it further. So to distill it down, he was speaking more about private biotech investment, but he viewed it as a conveyor belt, and that the seed VCs would form a few companies and they'd advance their products and they get further funding, and then they'd advance towards the clinic, which is testing in humans, and then they would get towards going public. And he referred to, we're trying to discuss what's happened in biotech over the lost half decade. And he said, basically the conveyor belt stopped, which is true. I, as a former public biotech investor, I left RS Investment Victory Capital back in May. The conveyor belt for me starts where his stopped. And the conveyor belt continues where typically a company will go public, consume exponentially greater amounts of capital as they advance their products to the market. But ultimately, at the end of that conveyor belt is big biopharma. They are at the end of it just gobbling up. That is the end game for the vast majority of small cap startup biotechs. That is their goal. And yes, the IPO, the private conveyor belt, stopped really the last year or so. It's completely halted. But that is because M&A stopped downstream and everything started to get backed up. The entire ecosystem was thrown into haywire.
Just need a little laxative to get it going. You know, it's funny, if you were to ask investors, when I think of biotech in general, I have memories of late 90s where in my head, you know, I think tech and biotech somewhat similar. And I think if you were to ask the average investor, say, investor, since the bottom in 2009, stock market's been a 10-bagger, Qs have been a 20-bagger. You know, where do you expect the biotech sector, the returns to have been? I think most people would say 10 or 20-bagger, maybe 20. And then the reality is it's like 4. Biotech is interesting because it's like one of these sectors that every like 4 or so years you get this kind of face ripper. But this has been a period of, I mean, almost a decade of kind of sideways-ish. Does that sound right?
Yeah.
Which I love. We're kind of drawn to these contrarian, we've been talking about uranium stocks and coal stocks and gold stocks, and all of a sudden they get their moment in the sun. But let's lay a little foundation. Talk to us about, like, what is biotech? How does it work at a high level? You know, I think when people hear biotech, they immediately just think like drugs, but give us kind of the whole kit and caboodle.
Biotech is, in my opinion, the most diverse industry that's out there. It's really its own sector. And when I say biotech and pharma, I use those terms interchangeably. It's really semantics. And we'll get into that a little bit later, but they act the same. They pretty much are the same. Gilead's considered a biotech company. They sell, for the most part, pills. And Bristol and Merck are pharma companies, and their biggest products are antibodies. So going forward, when I'm referring to biotech, pharma, it's all the same. So it is the most diverse industry, in my opinion. It's much different than the other part of healthcare, which is generally services, devices, med tech, tools and diagnostics, those types of things. Biotech, they are trying to cure cancer, make us thinner, obviously GLP-1s have become a big thing, grow biofuels, and make us all look better. Trying to do all these different things and doing it in all sorts of different ways. The Russell really doesn't know how to categorize these things. It's kind of a catch-all. But depending on which index, and I tend to look at the growth indices, the Russell growth indices, but it is the majority of healthcare. It is its own sector. It should be treated as its own sector. And what you're generally trying to do is advance a product, an idea, to the market. And but these are incredibly long, capital-intensive cycles. It can take 8 to 15 years for a product to get to market. You need to first show that it works in animals. Well, first you have to come up with a hypothesis, show that it works in animals, show that it works in man, and then convince the regulators to approve it and then sell it. So there's scientific risk, regulatory risk, commercial risk. And it really is an exponential compounded risk where the small minority of products that start out actually get to market. And when you consider the survivor bias, and it probably costs explicitly, let's just say $800 million to $1 billion to bring any product to market, wide error bars around that. But if you consider the ones that did not make it to market as well, because you should, that's the cost of the industry, it pushes $2 billion.
A lot of money. If you look through like traditional phase trials, I feel like it would surprise a lot of people. It's like almost like the CFA exam, but way worse odds, where at each level, phase 1, phase 2, phase 3, there's just a huge culling of the population of drugs. It's just hard to get through and a lot longer than most people expect.
There's a great saying in biotech that the most successful phase 2 is one that is, a negative outcome that prevents you from running a much more expensive failed phase 3.
I feel like a lot of people think of biotechs as lottery tickets. Has it just been the case where like there's been a lower batting average, like the products, like there's just not as many good products coming to market, or the stocks get way ahead of themselves 10 years ago? Are there just, what's going on?
I love that you're asking this, and I love the way that you just phrased that, because these very questions came up at my old fund. Is the science getting worse? And the spoiler is no, the science is not getting worse. The issue over the last 5 years has been a macro one, and it's all about rates. To confuse things, going back 25 years, every rising rate cycle was actually confirmatory for a positively correlated with a good biotech tape. And that's because all of the prior rising rate cycles were trying to tamp down a hot economy. And in a hot economy, people are doing risk seeking, and biotech is the tip of the tail as far as risk seeking. And the prior bear markets and prior corrections were on average about 9 months, 6 to 9 months. The most was 18. And then February 2021 came on. And post the pandemic, there was the infusion of liquidity, all sorts of companies going public, biotech companies, all sorts of non-earners. And this is the meme stock, the peak meme stock was right around February 2021. And a different interest rate, rising rate cycle came on. And that was economy be damned, get inflation under control. And biotech was the economy be damned. That was the tip of the tail. And that started a prolonged bear cycle, which we are just coming out of 5.5 years later. It's incredible. But it really is a lost half decade.
I feel like a lot of investors, particularly beyond the retail cohort, they'll say, hey, hold on a second. Look at all these biotechs trading at cash, or in some cases, there's more cash than the market cap or enterprise value. And people are like, well, we should just buy all these. But what they don't realize is, also that a lot of these companies are burning that cash. And what's the average amount of cash a biotech has? Like a year or two or three or what?
So this is where a lot of biotechs got caught up. It used to be you're trying to feather or thread the needle between too much and unnecessary dilution early on and having enough capital that you can control your destiny. I think of these companies as defensive business models in the near to medium term. And that raises a lot of eyebrows. But the reality is that a well-funded biotech, that phase 3 trial that they're running, on the assumption that it's capitalized, it's paid for, is going to read out irrespective of what's happening, Greece defaulting, oil futures, Russia invading Ukraine, all of those macro factors, Liberation Day, all that sort of stuff. So in the near to medium term, these business models are defensive. However, in the present, they're a little bit of Schrodinger's box. You don't know when they're executing this trial. There's not a lot. You don't know whether the product is dead or alive until you get the outcome. And then the variable at the end, and this is what changed in the last 4 or 5 years, is how much you get paid on the back end. And because M&A stopped, you get to the other side, you've developed a product, and then you're like, all right, now what? I'm not going to build a sales force to sell one drug. That doesn't make economic sense. And that is part of this conveyor belt stopping, that if you don't know that you are going to get paid, and you refer to use the term lottery ticket, Dan Rasmussen used that as well on that podcast. I think of this more like poker. That this is a game of skill, not a game of chance. And the way I'm trying to look at things is purely expected value. I'm trying to figure out, how much am I going to get paid if it works? How much is it going to cost me to participate? How much do I lose if it doesn't work? So where am I in that reward to risk ratio? And it's incredibly asymmetric, certainly right now. And then what are the odds of success? Now, unlike poker, you don't have a discrete set of outcomes in a 52 card deck. There's a lot of qualitative analysis that goes into this, and you have to build error bars into your analysis and any of your figures. But I don't view them as lottery tickets. It is a game of skill. However, that unlike poker, you don't ever know exactly what how much money is in the pot. And there's also the opportunity to take your money out of the pot or put more in throughout the hand. And then going back to where people are starting to, their interest is peaked. The only quant model that works in biotech is absolutely terrifying, but it's by the blow-ups. If you just are getting odds on your money and you just buy, it's a low batting average, high slugging percentage quant model within an industry that is low batting average, high slugging percentage. And it is an absolutely terrifying.
That sounds scary. I don't, like.
Or it's scary because they're blow-ups for a reason. And if you read any of the research, it's going to say that we don't, there are no prospects for the product. You just have to make sure that they have, and we'll come back to cash runway later in this podcast, but you have to make sure that they have a viable path. As I mentioned, that defensive business model is only defensive if you have cash. If they have cash to turn over the cards and see if their products work, then yeah, buy them all. And you just know that you're getting odds on your money. It's like buying all the long shots in horse racing.
I know this is hugely variable, so bear with me. But Just to give the listeners a little perspective, let's say it's a one drug company. Is there like a ballpark in my head, it's like, all right, this is preclinical, this is phase 1, 2, 3, public. Is it like 50 million, 300 million, a billion, 5 billion, like in their head? Like, are there, I know it's so specific.
Massive error bars because of however, let's start with the end and then work backwards. And this is where I'm a keep it simple guy. We kind of skipped over my origin. I have limited biology and chemistry background. The irony is that you have the biology degree, I have the economics degree, and then we were ships in the night. And I don't know. So I got into this just purely from the game theory component of it. I just wanted an equity analyst job on the street. I wanted to be on the buy side, and I finally got one. After getting through the first 2 levels of the CFA, it makes you a little more marketable. And my first job was as a junior analyst with large pharma. And I started analyzing the pipelines and just doing what I was told to do. And it wasn't all that interesting because it didn't move the earnings numbers by a lot. But I learned that a lot of these products start out as single product entities, small companies that are trying out an idea, moving fast and taking risks, and then big pharma would acquire them or partner with them. And then the seed at RS back in 2007 opened up, and they went at it with the same view that a lot of generalists go at it. And they're like, okay, I need to be able to sleep at night. Find me something that's small. We were small cap investors, small cap, growing, and profitable. And I would draw that Venn diagram, and there was a unicorn in the middle, and not like the $1 billion unicorn, but the doesn't exist unicorn, because you couldn't have all those. You can choose 2 of the 3. It could be small cap and profitable. That means it's not growing. It could be growing and profitable. It is way out of your market cap range. Or it's small cap and growing, and they're spending, if they have any revenue, they're spending all of that and some on their pipeline. And that's what investors want. And they want these companies to develop new drugs.
As we work back, like if you get through the phase 3, you're probably going to be $1 billion plus company, right?
Yeah. So this is how I would think of things. You could build a DCF, and you can tweak the discount rate based on how risky you think the program is. I paint all of biotechs in the risk spectrum. They're all kind of the same. So I use the same discount rate. Right now, you'd use like 20%, maybe 25%. And figure out what the value is if they get to their destination, and then discount it back. And then I would handicap it by likelihood to work. That's just how my mind works. Just again, trying to get it into that poker bet, pot odds type thing. Years and years ago, I was sitting next to the Lilly CFO. I don't even know if it's the same CFO. But they'd acquired one of my favorite oncology companies. And I was just like, how'd you think about that acquisition? And he said, 5 times peak sales. If I can get something at 5 times peak sales, I know that my reps will make money with it. And if that's good enough for him, that's good enough for me. There is some nuance. He's talking about the gross margin on these things. You mentioned tech, very similar to software. These are the vast majority of products are just salts, different chemical salts. And they're 99% gross margin, something like that. When after you've done all of the research, now you can just print these at a plant in India. I guess they're all going to be brought onshore now. But provided it is a small molecule with long IP, 5 times peak sales. If you have shorter duration IP, you'll haircut that a bit. If it's something exotic like cell therapy that is more expensive, longer sales cycle, and lower gross margin, then you'll haircut that a bit. But I'll start with my stake in the ground is 5 times peak sales. So $1 billion drug, $5 billion that they get. That's what Lilly will pay for it. That's what I'll, in theory, pay for it. And then you want to discount it a bit back by how many years will it take to get to the point where big pharma would pay that multiple. So maybe it's a 3-year discount rate if they're in phase 2. And then there's some great data out there that shows clinical trial phase by therapeutic category and the success rate. So as you mentioned, the CFA that was roughly 30% each level, compounds to 9% success rate, you would see like a 95% chance of if you file for approval that it gets approved. 1 in 20 actually get rejected. And a phase 3, let's just say 75% of phase 3s are positive and advance to filing, and then 40% of phase 2s, and then like 10% of phase 1s, and you compound that. But that can be your anchor point. That can be your reference point if we're looking at, an infectious disease product in phase 2. I know that historically 60% of these phase 3s are positive. Actually, in that area, it's higher, like more like 85 or 90. It's the phase 2s in infectious disease that are the gates. But I start there and then apply that handicapping to what Big Pharma told me they'll pay for this thing.
There's the old biotech joke is that everything kills cancer in phase 1, right? You just got to get it through, does it actually not kill the patient, and is it tolerable? I was looking at, there's like 300 biotech stocks out that are like above 100 million market cap and below 5 billion, goes up to almost 500 if you include the kind of big, mid, large caps. That's a lot of companies. How do you think about even sifting through that? I mean, back when I used to pay attention to biotech, I used to always think of, it's almost like mining in my mind, where you have some execs and some people where it's like success leaves traces, right? You're like, all right, they've done this 1 or 2 or 3 times. That at least cuts off the long tail of some fraudulent nonsense. But how do you make your way through so many securities? Can you be a quant in the biotech world?
It's so difficult to quantify, and I'll give you an example. Let's address that while you brought it up. A quantimental screen, an example of a quantimental screen that would try to put, let's just say, the Russell 2000 into quintiles, highlighting all of the things that you love and your listeners love, like ROI, buybacks, expanding margins, revenue beats, all of the hallmarks of great companies going back to what you and I studied in college. There's an example of a 63-factor model that works great for all things non-biotech. 54 of those factors were NA. Things like accruals, and just not relevant, not anything they're trying to do, not anything they're ever going to do. And this is stuff that your friend Dan picked up on that podcast earlier this summer. Then the remaining 9 that actually are measurable are often contraindicators. This is what makes it so difficult, is that, yeah, sure, we all want buybacks. Everybody wants buyback, all that stuff. Nobody in biotech is investing in a company for buybacks and return. Capital raises are part of the business model. And if you are to ding a company for that, now you don't know why in a vacuum, you don't know why the raise happened. The raise could happen because they're struggling, or the raise could happen because they just had exciting data and the stock's up 100% and it should be up 200% and they're going to advance from phase 2 to phase 3, or the whatever positive factor just changed the fate of the company. Operating margins, Dan hit on this. Sure, we all want expanding margins. As you get closer to market, as you're advancing this product, everything gets exponentially more expensive. You need to build up inventory for these medicines far ahead of launch. The clinical trials of phase 1 might be 10 million, phase 3 might be 300 million. I like to think of these as real estate projects. Just think of a partially completed real estate project, and it's not completed yet. You're not generating rent, but there's some value in getting through permitting, putting the foundation in the ground, framing, but things get exponentially more expensive as you advance towards completion. So from a quant standpoint, really all you have to hang your hat on is EV to cash. It's just how much tech value is there and how much cash do they have? And then within that, how long is that cash going to get them? If, all the $400 million is not the same to a company that's spending 500 or a company that's spending 100 a year. From a screening standpoint, where do you start? And you're right, there's 500 or so companies. This is one of my favorite questions for you, and this is emblematic. I try to invest in what biotech is and not what I wish it would be. Use some numbers from a little while ago, but small cap growth biopharma, the weight, not the number of companies, but the index weight was 20%. Large cap growth, Lilly and the brethren, 10%. What do you think mid cap was? 20% small cap, 10%.
15.
That would be the obvious assumption. Back then it was 3%.
Why?
Because companies don't live in that space.
Yeah, because they hit the milestone and they get acquired.
Right. So the assets get from small to large. Very, very rarely the companies get from small to large. Maybe there are 5 over my 20-year career that Regeneron, that actually still exist. Vertex, Regeneron, and Alnylam maybe are the 3 that are currently public. The vast majority, you have this bolus of companies that are small, trying to get their assets to the other side. In some sense, they themselves are trying to get to the other side. And then you have these companies that are there, and they're really marketing companies for the most part, in my opinion. And then you just have this dearth of names in the mid-cap space that are kind of in no man's land. Again, going back to why this space is so unique, the profile of those types of companies is vastly different, even though they're in the same industry. As we've discussed, small cap companies are the tip of the tail, highly risky ventures. The large cap companies, large biopharma, are the most defensive of the defensives.
I feel like everything you're talking about is why people kind of shy away. They say, look, these suckers are it's these binary events. It's so volatile. I'm just going to sit this one out. Does that feel like?
Colby, why don't you pull up slide 11. This is from Steve DeSanctis at Jefferies. I love this slide. This says so much about generalist managers that over a cycle of a decade, the idea that you would be secularly underweight a sector that's in your benchmark boggles my mind. And they're consistently 20% underweight the sector. At the peak of the pandemic, when biopharma was 24% of the benchmark, they were 50% underweight. And I was speaking about this with our friend Brian Jacobs about how crazy this is, because they think that they're being conservative. They think that they're risk averse, they're conservative. Biotech is risky, therefore I will not own it. But the reality is they're exposing themselves to tracking error. This is like driving on the highway, being afraid of traffic at 70 miles an hour and therefore driving 30 miles an hour. You are going to get run over. And when this is half to 2/3 of the benchmark, this is like a kind of a dirty secret for the consultants out there, that they want to show that they're equal weight at the healthcare level. When you're 20% underweight 2/3 of the benchmark, when you solve for that, that means you have to be 40% overweight the remaining share of healthcare, tools, diagnostics, med tech, which trade completely differently. So you have now opened yourself up to all sorts of beta risk and all sorts of tracking error that is unintended.
Is this just like some sort of behavioral situation that's just going to continue to persist? And why do they do it?
Biotech investment is very much communal. And we see each other at these conferences. We know we'll see each other in San Francisco in January, in Boston in March, Miami in December. It's very much a movable.
You guys also do a hilarious, it's like the flip side of the Wallach Beth in Park City. Run into you guys running around Main Street in Park City too.
Yep, there's a lot of risk-seeking personalities, really nerdy risk-seeking personalities in biotech.
Those are my people. I like it.
Yeah, and there's almost like a therapy group for those of us who would have to deal with generalist PMs. There's a group there. At one point, the analyst, these are the portfolio managers who are managing the billions and billions of dollars, and they're depending on the biotech analyst or PM. For a lot of these, we manage our own specialty fund, and then we, consult on the broader fund as an analyst. And they were not allowed to use the names of drugs morning meetings because the PMs couldn't keep them straight. And it's like, that's just tacit admission that you should not be investing in this space. And it's like, look, just you decide how much of this space you want to own, and then just let me pick the stocks. If you deal with the beta, I'll deal with the alpha. But these ideas all die in committee, and this irrational risk aversion where people can call these things lottery tickets, and then I just see them trying to guess NVIDIA's next quarter or Tesla's next quarter. Or
your description earlier makes sense, is that if you view the world through a certain lens and a framework, and that framework doesn't work for a subset of stocks, you don't know what to do with it. You're just like, well, if I can't apply my lens here, it just looks too variable. You need to be a PhD, MD to do it, a doctor, and these things are too volatile, too big of drawdowns.
And the reality is, if they weren't in the benchmarks, most of these funds would not be investing in them. If you go to slide 4, showing a bit of what I was just speaking about, I just started out trying to figure out, what is this industry? What makes it move? What are the knowns? And then let me try to solve how to best invest in it. And looking at what biotech is and not what I wish it would be, we all wish they were dividend producing, high growth stories that, have 1% volatility in a given month. That's just not the case. So looking at the Russell 3000, and I'm just defining small cap as less than 20 billion in the grand scheme of things. This is not the way the Russell defines them, but it's kind of small SMID, but relative to NVIDIA, these are small caps, and certainly compared to Lilly. 97% of companies in the Russell 3000 are small cap in therapeutics. Biotech is small caps. And then within those, 93% of those companies rely on outside funding to exist. Those are the companies that I just referred to that are doing the secondaries every 18 months or so. Where we are in this cycle now, if you go to the next slide, this was making the rounds on LinkedIn. This is an Ernst & Young analysis, and this is how much cash, and maybe you asked this earlier, I guess, like, what's normal for these companies? And it used to be that the right answer, roughly, that you should go into each event with about 18 months of cash. Priorities have about a year of cash. Historically, this is pre-pan.
Very milestone driven, right? In their head, they're like, we need to get through the next thing.
Yes. The reality is these companies should be private. They really should be, or we should collectively fund a program to a milestone, forget about it for a while, and then get the results, all get back in the room, do a Dutch auction, figure out what the value is, and then advance the company further. But that's just not the way it happens. These companies need exponentially greater amounts of capital. That capital lies in the public markets. That's why these companies go public. So this analysis by Ernst & Young's is the Biotech Survival Index. They've been doing it, I think, only as far back as 2016, something like that. But the last 6 years made the rounds on LinkedIn, and people were shocked, pearl clutching. 60% of companies only had 2 or fewer years of cash. And as someone who's been trafficking in these ideas, remember going back to the prior slide, that 93% of these companies rely on outside funding to exist. I saw 2020 and 2021 as the outliers. Typically, these companies, to thread the needle, you don't want to dilute yourself. Let's just say that 10 million and 300 million example, phase 1, phase 3. You don't want to raise $300 million at today's valuations before you know if the phase 1 works. The sweet spot used to be about 18 months of cash. You'd never want to go into it with less than 1 year, and 2 years seemed a bit too much. There are rare examples of people pushing companies to return cash to shareholders because they weren't going to need it for the next few years. Post-pandemic, the goalpost shifted as the conveyor belt backed up. And the world started to require more capital, that 2.5 years became the new 18 months. To the point where, and this is a great slide, if we go all the way to slide 14, this is the unsolicited advice. Part of the way is a low fee paying mutual fund portfolio manager. Part of the way that I would get my access in the biotech world was to be an active participant. We were never going to pay Morgan Stanley as much as their prime brokerage relationships did. So to get in the room for any of these meetings, I would be an active participant. And I took a lot of testing the waters meetings. And the testing the waters meeting is a company that's thinking about going public, and they'll want to speak with prospective investors and get feedback on their pitch and find out if you're interested. So this is my unsolicited advice to all of these managers. And this comes from Jim Burgeneau, who is a banker at Barclays. And he had this back when he was at Wells Fargo. He spoke this to me, and he relayed this to me at lunch, and I kind of drew the curve. So these aren't exact data, and so don't quote me on these numbers. But he said they looked back, this post-pandemic, at share price responses to positive data. And that is, you have to suspend your disbelief for a moment. That we're trying to hold constant positive data across all these different therapeutic categories, 3 different phases, what is positive, what isn't. But to the extent we can hold constant, these were positive data. What was the share price response? And if you had less than 1 year of cash, your shares went down by 40 to 50%. You did your job. You advanced this scientifically. But now you have now it's the dog chasing the car and catching it. Now what? Great, you ran this phase 2 trial. Where are you going to get think again about the real estate analogy. Where are you going to get the money to finish this project? And the people who come in and take over this suddenly distressed project are going to get it at a discount. This is what was surprising to Jim and me, is people with less than a year of cash always were punished for a telegraph financing. The 1 to 2 years, this used to be the sweet spot. And this is when you just asked the question, my colleague Paul asked this question years ago in a meeting when he said, is the science getting worse? And to anyone who's in the weeds and seeing the advances in sequencing and what's happening in the publishing world about scientific advancements, of course not. However, it's an entirely reasonable question to ask because every stock is going down in spite of this quote unquote positive data. And again, that's because the capital markets were shut up. So even if you were in the sweet spot where you would thread the needle or between irrational dilution and having not enough money, your shares would still go down in that 1 to 2 year.
What's the answer? Is just take your medicine and raise more money?
100%. And that's what we're starting to see. There was a period where people were wondering if this was a transient situation, and you did not want to be the fool who, raised during this panic situation. And there are some of these companies that just happen to do their raises in every global freak out, like whatever cycle they're on, there's a 1 week freak out. But what's happening, and one of the reasons that the biotech markets are healing, is that there's consolidation around a certain amount of companies that are going to survive and go forward. And M&A has opened up a bit, and companies are realizing that they're not going to be the only one to do this dilutive raise. And I wrote this little piece on LinkedIn, just trying to talk to operators saying, like, look, I know you see this as dilutive, but the reality is it's accretive if it gets you from under 2 years to over 2 years, and then you can get value on your data that you're waiting on.
One of the challenges for a lot of people, they want smooth sailing, and biotech on a one-off is binary for many of these. which is scary. And as the industry as a whole feels super volatile, also scary. So maybe you have the behavioral bias against it. Like, what do you say to people that are all these active managers and folks that are scared off by this world?
So there's a perception reality. But if you could pull up slide 6, this is an example of a drawdown. And this is going back to January of last year, or 2 years date, roughly 2 years of data here. But this is Apple. And this is, what low did you touch after a 52-week high? So this is an example of an 18% drawdown and a 35% drawdown just in the this is in the last year. And that's obviously that most recent drawdown is on Liberation Day. What do you think, Meb? This is incredibly consistent data. The mean and the median are essentially exactly the same. Going back 25 years, in the Russell 2000 growth, what do you think the typical drawdown in the typical year, in the typical stock, all sectors, is? If you own a stock, if your stock is at 100, it is likely to touch what?
What do we got? 20, 25%?
That is a typical response, and it makes a lot of sense. The answer is 50.
I'm thinking in my head, maybe I'm thinking of the index. I feel like the index is usually averages like a down 15 or 20. All right, so down 50, averages 50. Okay.
Okay, so now what do you think biotech is?
80.
Yeah, so that's a very...
It's worse than 50. Worse than 50.
You're absolutely right. Of course, it's got to be worse than 50. So it's 60. If you go forward to slide 7, this is the perception reality. So here I've carved out non-biopharma, which is when you pull the biopharma out, it goes from 50 to 48.5%. So non-biopharma has a 48% drawdown in a given year. Biotech has a 60% drawdown. Pharma, which is why, as I mentioned earlier, that I think of these as the same. And when people say they want revenue, so they want it in their therapeutics companies, so they want to sleep at night, pharma is more likely to have revenues. You don't get any downside protection. So what I say is, yeah, small cap biotech is volatile. Absolutely. However, the first two words, small cap, drive 80 to 85% of that volatility. And to invest in these stories with asymmetric upside, you're only taking on another 12 to 15%, percentage points, 20 to 25% more volatility to have the opportunity to make bags on bags on bags of money.
So do we just sit around and say, put in the orders down 60 for every biotech? And well, that goes back to your comment earlier.
So now let's go to the anatomy of one of these drawdowns. So this is one of my favorite stories. This is like a Bond villain disease. These patients have a genetic mutation where they have this photosensitive toxin in their bodies that if they go out in the sun, they have excruciating pain. And this company's developing, they also have serious downstream issues. I believe it's liver toxicity. Companies also developing later on, they're developing, or earlier stage, they're developing some anemia products. But for the most part, it's all about this product in EPP. And the anatomy of one of these drawdowns, the first one is phase 2 data that came out. It was, let's just say, misinterpreted. Street expectations were ahead of what they put out. There was a placebo effect, which would be easily sorted in phase 3. You just do what's called a run-in. You put everyone on placebo for a month, and then you randomize so that you get that placebo effect out of the way. But the share price was, cratered on what was really good phase 2 data, as history would bear out. So this was your buying opportunity. And if something's down 60%, what that tells me as a stock picker, I don't even have to be a world-class stock picker to have, assuming the shares recover, to be able to make 150% on my money if I'm just buying these fear events. And sure enough, in this example, The data came out, started to talk with the FDA about the path forward. And what you see that next gap up in a few months later, I think that's towards the end of last year, the FDA actually said, yeah, come on and file on the phase 2 data, and we'll worry about phase 3 later. You made your 170% recovery. Company really should be more valuable than it was going in because they've de-risked this program. And then along comes the macro issues. So the first was company specific. And the second was Liberation Day, that we saw that Apple traded off 35% over this period. There's a higher beta story. Of course, it traded off more for none of its own faults, but just because it was similar to all the other stories, not because it was different. And again, you get just a fantastic buying opportunity. And then as of this morning, they had a good voucher presented to them as being a meaningful medicine, and that they get some money in their pockets, and it shrinks the time to market. You get a 200% rebound from the April lows. This is anatomy of a drawdown.
I feel like Bessenbinder, who we had on the podcast, and we've done a fair amount of work with over the years, talking about a lot of his research. He's got some great charts. We'll put in the show notes, links, listeners, talking about successful companies. And this isn't limited to biotech, but Chris was talking about Apple, but the drawdowns they faced over time. And I think the stat for Apple is that every year it's been around, it's had at least 150% drawdown. And this is the biggest company, one of the biggest companies in the world. So it's interesting, the opportunity that's presented every year in a lot of these names. I mean, looking at this one, it's like you get your shots if you want them.
Yeah, I think NVIDIA was 50% just earlier this year. Yeah, 150 to roughly 40%. You get your opportunities. Now, let's talk about the broader market, because not only are you get your odds on your money. This is why, yes, 100% should be starting. This is the time to invest in biotech, in my opinion. The bottom is in. We're starting to see healing. M&A is starting to happen. The IPO markets will open. However, there are bargains on bargains on bargains out there, and those goalposts of shareholder expectations of how much cash you need on your balance sheet. Now that the capital markets are opening, now those can start to shift back, and that chart that we put up with maybe you don't need 2 years of cash on your balance sheet to see a positive return, because investors are confident that you'll be able to fund that next event. Colby, if we could put up slide 10, fourth quarter last year, but it's not that much different today. So this is, as I mentioned earlier when we were talking about quants, the only thing that you can really hang your hat on is EV to cash. To layer on top of this would be to divide cash by runway to see how many years of cash you have. That would be the fantastic way to do this. But this is just EV to cash. How much valuation is there relative to cash in small mid caps? Again, Jim Birchineau at Wells Fargo started this, or when he was at Wells Fargo, and I kept this going for a bit. But this is just the aggregate set that they were following. Where are they from an EV to cash standpoint? And we would view as a buy signal anytime it would dip below that lower red line. And it's small fonts.
Roughly 3 times.
Yep, roughly 3 times. So this is, again, courtesy of Brian Jacobs layering on top of
former podcast alum, Brian Jacobs, who's now at Aptus. Listeners, you can find his old podcast in the archives. All right, keep going.
So he layered on forward returns from one of these points in time. And this is just valuation. If you are buying above those 2 red lines, you're seeing really 0% forward return. If you're buying between them, you're getting market-like returns. And if you buy the market below that red line, you get outsized returns. It's 17% compounded. Of course, that made 2021 look like a buy signal. And 2021 was a buy signal, not because of price, but because of cash. There are 2 ways to get on this chart, and there are 2 ways to solve this chart. You can either have price come down or cash go up. And then going forward, you could have price go up or cash come down. So never did I think, my biotech investment career started in 2007. Never did I think we would see one of these generational opportunities like 2002. Then we got one. That's the good news. The bad news is that it stuck around for 3 to 4 years. But we're seeing the healing. There's all sorts of signs that the healing is going on. So the wind is at our backs. This is the opportunity to start putting new money into biotech. And I remember that Brian Ransom, that from where we are, 1.7 to 3, you have like an 80% move before you start the 17% compounded returns.
For the non-pros out there, say you're a financial advisor, say you're an individual, like, are there any good resources, or like how can they even think about this sector? I mean, there's obviously the big two ETFs, the big weights in IBB, BBH are very heavy in the Amgens of the world. I think they're market cap weighted. Is there any way to think about it differently, or resources if they even want to try to, do it on their own, or they just don't do it?
It's incredibly difficult. It's just an underserved space. There is no ETF that is really representative of what this sector is. And for your contraindicators, the XBI actually changed their inclusion criteria not that long ago to go up cap and higher liquidity at exactly the time that you should be going down cap and making committed long duration bets. What the world needs is more rational, long duration, evergreen capital to invest in this space. And the consultants are pulling folks in the opposite direction. So if I had my money in a diversified fund or a diversified strategy, I would tell them to invest in everything except biotech, because it's such a specialist area. And then let me get my biotech investment elsewhere. And the VCs are the ones who have the scientific knowledge, and their LPs have the risk tolerance. This is really the same asset class. And maybe this would be a good opportunity, Colby, to go to slide 2. The reality is that private biotech companies and public biotech companies are not that different. They're far more similar than different. We're trying to bring novel medicines to market, generate returns for investors, definitionally, because a lot of them are seed investors. That private investments skew earlier stage, publics are later stage. But when you go public, it's really just another venture round. And this line, I've drawn a straight line between the privates and publics. The reality is that it's really kind of a muddied fade, and that, and over cycles, during the pandemic, preclinical and phase 1 companies were going public. Right now, nobody can go public, so privates are holding later stage assets. But we're really trying to do the same things. An IPO, or another podcast alum, Tim Leahy, our friend who's a CFO, he would refer to a tech IPO, which is generally an exit, as a conflict of interest, where you're on these two paths that intersect at one moment in time. Everyone's interests are aligned on the day of the IPO, and then T+1, they start to diverge. That is true for tech. For biotech, an IPO is an entrance. An IPO is an opportunity for new investors with different durations to come in and help this product along on its journey down the conveyor belt to hopefully M&A. And it's an entrance. It's not an exit. It's an on-ramp. And what we need now, there's this wide gulf between privates who are trying to keep their existing companies alive, and the generalists who have withdrawn, and really the M&A, the folks who are on the M&A side. And filling in that gap with a combination, it's a perfect extension for venture capital money to offer the access to what's essentially the same asset class at a compelling, generationally compelling valuation. and see outsized gains as the conveyor belt starts back up.
I like it. Do you see a fair amount of, like, I'm sure you do, a fair amount of crossover funds in the biotech world, or does it tend to be pretty segmented between the private and the public?
There were a bunch. There were too many going into because it was free money going into in the pandemic. During the pandemic, and when I'm talking about the pandemic, right into kind of 2021, the industry was more interested in creating public companies than creating the next product. That was the front end of the conveyor belt. And crossover funds were clipping, 30%, funding a mezz round to, boost the balance sheet ahead of going public and knowing that they could get liquidity on this in I think like another 3 months or whatever it was, but they were just printing. Now, again, because the prior bear cycle was max bear cycle for our generation was 18 months, and now we're just coming out of 4.5 years. The folks who thought they were long duration found out that they're not. And then the next group that thought they were long duration found out that they're not. However, for those who have been on the sidelines waiting for I wouldn't go so far as to call it the all clear signal. However, and I've said this in a few meetings, that I'm still waiting in my career for someone to say the easy money is ahead of us. What I've strung together with the valuations where they are and a healing market cycle, that if you have the duration, if you are able to sit down at a poker table where everyone has been there for a long time and they are very stressed and they got to go home and they're on tilt, and you sit down with a new big stack, you can clean up. The long duration is the big stack of the poker table. And if you were to combine that, I rely on wisdom of crowds. I'll talk to 20 KOLs and figure out.
What's a KOL?
A KOL stands for key opinion leader. These are the smartest folks. And a lot of times they're the folks who decide whether a drug will get approved or not. But they're the smartest folks in a medicinal specialty. So I'll talk to 10 or 20 of these and get their feelings for the likelihood of a drug having positive phase 3 data. And you learn that they have their own biases. They never say 100, they hate extremes. They'll never say 100% even if they think it. They'll never say 0% even if they think it. You get modal outcomes, you get the responses, you get 25%, 75%. But on the whole, you'll get a pretty good representation for what the odds are of success that a lot of times are really different than what the market is pricing in. And then because this is all qualitative responses, this is not counting cards like you and I used to do up in Tahoe, and this is not playing poker with a discrete set of outcomes or only one card coming on the river. But these are qualitative outcomes. I'll look for 8-to-1 reward to risk, and then for a safety standpoint, I can cut that in half if my assumptions are off. I'm still making odds on my money. If I could, someone like me, who could be teamed up with some scientific, medicinal, statistical experts to hone that number and to reduce those error bars and to increase the confidence in what's coming out while understanding how the world works and that you're going to get these opportunities. Things are really set up well for someone with that type of strategy going forward. And there are some VCs who are doing it. Some of the ones who are getting, VCs operate in this spend $1 once IRR worldview. That doesn't really work well for biotech, or certainly for public markets. You end up looking for a very specific type of outcome, which is really a two-bagger over the next 18 months. Like that's what solves for. But you get these perverse incentives with a model like that of the spend $1 once. If it names down 90%, and it's worth 0, you should be selling to save that last 10%. But if you have to return that and that gets marked against your other products, you're incentivized to just let it ride. Conversely, let's just say you have this mapped out where something's worth $10 at phase 1, $20 at phase 2, $50 at phase 3, and you take a stake and all of a sudden it moves up to 20 in phase 1. And so you're getting phase 2 money on phase 1. You should definitionally, you should take some money off the table. But again, if you need doubles to make the math work, you won't do that. So there are folks who are, and you see them that they start out with their first fund is really their opportunity funds, their extensions. They're either funding their prior names that are struggling a little bit, or it's an extension of the same pool of capital that they have. And they have to follow this IRR, spend a dollar once platform or strategy. When they raise fund 2, they hone that a little bit. And when they run fund 3, they further optimize it. But really what you need is long duration, evergreen capital that's committed to the space. This is the endowment money. This is the stuff that I know you love. Sovereign funds could come in and invest in this space with confidence where they can ride out some of these cycles, again, knowing that you're getting in at a generational low.
I think we're going to have to name this episode "The Easy Money is in the Future." I'm definitely going to steal that and try it on TV the next time I go on. I had a similar pet peeve comment where people always said, in these volatile markets, in these uncertain times. And I'm like, bro, when has anyone ever come on here and said, in these mellow times, these low volatility? I mean, for a while, the VIX was pegged at like 12. I'm like, you can't call these volatile times. Like, these are the least volatile, the most certain times. So I tried it once, and the hosts, halftime aren't paying attention. So I said, look, in these kind of low volatile certain times, and I went on with my statement, and nobody paid attention, but I was quite proud of myself. So next time on is the easy money is soon to be made. That's going to be crazy. Easy money's in the future.
Easy money's ahead of us. The other one that I love, that I wouldn't buy a position today, but if you already hold it, hang on to it. That's another one of my favorites. That the trading costs are really what you're worried about between buying something today. And
we've been trying to this giant behavioral bias that we've been dealing with for this year. There's so many people that have made a ton of money on a group of stocks like the Mag 7. And because that's what's brought them here, they don't want to sell it. They're like, well, I should hold a concentrated portfolio. Then you show them the historical research on why you should absolutely not hold a concentrated portfolio. And it's a terrible idea on average. There's always the outliers. But you ask people, say, look, here's your portfolio. Let's say you got 10 million NVIDIA. And it's like your whole portfolio. And let's say magically you could sell all of it, defer the taxes, and you look at your account tomorrow, your Schwab account, got 10 million cash. Would you go buy 10 million NVIDIA? And not a single person would ever say yes. They'd be like, no, are you crazy? I'm going to YOLO all my money into NVIDIA. You're like, well, that's what you currently are doing. Like, what are you doing? So,
yeah, it's a reality in the biotech world as well. That people have there is a shocking amount of, buying high and selling low because you have these uncorrelated moves. And you're like, well, mine is here. And I'm looking at that other one that's going up there. The benchmark weights play into this. We can get into some stories, but there is a flywheel effect that keeps a lot of these companies going. I know you've been on the equal weighted versus market cap weighted hill for a long time. And I agree with you in so many ways. There are so many generalists who look at an elevated market cap and associate that with a lack of risk. That if we're looking at two companies that are in the oncology space, one is $4 billion, the other is $200 million. The $200 million one is the risky one. And the reality is that the $4 billion one just has further to fall if things go wrong, assuming other things are roughly equal. And they often have a non-committal shareholder base that the specialists have moved on. I see this a lot where they move to the next emerging biotech and the company has a setback and they're just in this no man's land between, maybe they have a year delay in approval, and they just get overly punished because the generalists are like, whoa, I thought this thing was de-risked. And the specialists have moved on, and these opportunities just are presented to us.
Tell me a little bit more what you view as the same asset class, some of the different perspectives, VC, public PM.
I'll tell you a funny story. I was down in Mexico at this group of primarily San Diego-based operators and VCs do a surf-based retreat every year in Cabo, the Cabo Surf Hotel. I was invited to it. I was one of the only investors there. It's really not a lot of investors. It's primarily for private VCs and operators. And I was invited, the incredible surfers. So you've seen me surf. Actually, you might never have seen me surf because I'm usually riding on my stomach on a wave. But you see me slosh around in the water. These guys are world-class surfers. And they're also incredibly intelligent folks. And, some huge and important companies have come out of this group. So I'm coming off of 3 days there, and I'm actually excited to decompress. I get onto the plane, and the empty seat next to me fills up with a guy named Amir Nashib. And Amir was one of the three heads of the group. He's a VC out of Boston, incredibly intelligent and thoughtful gentleman, MIT educated. And he just wants to talk. He loves to talk. He asks great questions. And I just want to stare out the window. And I was so intimidated being at this conference. This is probably 12 years ago now. Some of these guys are my best friends, but including Amir. So Amir asked me, he's like, how do you think about investing in companies? And so I went through everything that I've been laying out for you here, that I think of it as a poker hand, that I'm trying to figure out that last card. What are the odds that it's a jack of spades that I need to complete my hand? How much is it going to cost me to see that card? And what do I get paid if it is? And what do I lose if it isn't? And he thinks about that for a second. And he goes, what I do is do everything in my power to make sure that when that card gets turned over, it is the jack of spades. And I like that your worldview is entirely probabilistic, and my worldview is entirely deterministic. And that is the difference between the privates who have board seats and are committed and they see underneath the hood, and the publics who, what we're doing is we are accepting imperfect information set in exchange for liquidity. And as a consequence, we have to deal with these issues being marked to market every tick mark of every day, which they shouldn't be, but they are. And, that stuck with me. Colby, you could put up slide 3, because I tried to show these two just diametrically opposed viewpoints that are really trying to accomplish the same goal, advance these medicines, in theory and really in practice. We are a community of biotech investors. We're not so different, you and I, the privates and the publics. We are a community of investors who are arbiters of meaningful medicines and helping ensure that the most exciting medicines, generally defined as valuable monetarily, but the most exciting medicines are the ones that get the capital and the attention to get to market. But we're doing them from completely different points of view.
So, as we talk about biotech, I feel like most people in their heads are thinking US, but as we've seen with Novo and other biopharmaceutical companies, and, this is a global market. How often do you look outside our borders, and what do we think about China?
Yeah. So you tip my hand with that last part of the question, but until, let's call it 6 months ago or a year ago, the vast majority of innovation is happening in the US. And even Novo, yes, Novo is the European company, but ADR, a lot of these companies, the European pharma companies are headquartered in, or do a lot of their business in New Jersey. And vast majority of the tradings and ADRs and your US exchanges. I would actually say that a disproportionate of money that I lost over my career was on illiquid ADRs, European and Australian. So it's just safer to invest in the US, where investors, I would just say, are more savvy. And we all agree roughly on what these companies are worth. There is a bit of an arb that you just don't get the value in Europe. But if you list in the US, you can bump your multiple a bit. There are some weird acquisition rules and limits in Europe for some of these companies, so they can't be acquired in the same way that the US companies can. So it's just there's enough opportunities in the US that we really don't need to look elsewhere, except for China of late. So more and more you're seeing in licensing of companies or of products from China. There's some Me Too type stuff, but there's also really good innovation going on. And the FDA is increasingly accepting of research studies that are performed in China. Summit Therapeutics is a great example of a very successful, you mentioned earlier about these trails of investors that have made money. The guy, Bob Duggan, who is behind Pharmacyclics, which is one of the biggest, most successful stories of our generation, great book for blood and money that folks can go out and read and see what it's like to invest in biotech companies. He's doing it again with a Chinese asset, a version of Merck's Keytruda, PD-1 cancer drug. It's bispecific and out of China. It licensed it, the rights, and now it's I'd have to look it up, but it's like a 25, maybe much more. Let's see where it is. $15 billion company, kind of out of nowhere.
Anything got you hot and heavy for categories within biotech? I feel like, you see certain product pipelines and ideas and developments, or anything you particularly would avoid as well?
Well, in general, you're looking for low capital intensive, predictable results. So what we would refer to high capital intensity as science projects, where there's a lot of overhead. We don't know what we're really solving for. It's a technology in search of a use, as opposed to single product stories in an existing therapeutic category where you are meaningfully moving the ball, or advancing the ball, but you're not plowing the road yourself. And the market likes single product stories. The specialist investors like single product stories. I believe the generalists overvalue platforms and they overvalue multi-product stories. We're really looking for things that are going to get acquired. I mean, that's the end of the day. When a story gets acquired, it can't have a 50 or 60% drawdown or more, like we mentioned, happens typically. So single product, small molecule, bispecific antibodies are having a day. Things called antibody drug conjugates, which is, antibodies are very good at targeting something, but they don't do a lot when they get there. If they can carry a payload like a chemotherapy, that's the best of all worlds, where you're getting the chemo only to the tumor, but nowhere else in the body. Chemotherapy as a treatment really is a scorched earth try to, harm everything in the body, and the tumor's not going to be able to bounce back the way healthy tissue will. Well, if you mount this onto an antibody, then you don't have to worry about that contagion or collateral damage. On top of that, there's radiotherapies. So beyond a chemotherapy, now you can deliver a radioisotope directly to a tumor. And then anything that triggers or harnesses or wakes up the immune system is always interesting, because it's a catalyst that gets the body to heal itself. I like to, I love my analogies, but cancer is just something that's growing that is avoiding detection. It's either avoiding detection by the immune system, or it is detected, but the immune system is not activating against it. So there are things called T-cell engagers. It's a bispecific antibody will grab onto the tumor, and it will grab onto the immune cell, and it will bring them together. It'll be able to be like, look, you fool, the tumor's right here in front of you. And then maybe if you put a pinch of some other cytotoxic agent in there that will just break the tumor up, now all of a sudden it will recognize some of those bits as foreign, and you'll get a great immune response. We are in the golden age of biomedical advancement, and that will last until tomorrow, and when we'll be in an even better age. Science is advancing incredibly rapidly. When we would invest in companies like Illumina and the ecosystem that is helping to develop these drugs, I would refer to it as Moore's Law running on a moving train. That because you're getting the computational benefits of Moore's Law, and then they're figuring out the chemistry, and now it's really become a big data problem. There was a period back when we were doing our Illumina investments where the networks, the fiber optic cables were not big enough for Harvard to talk to Stanford. And they would have to mail. We had a tangential investment. I wish I knew the name, but it was these solid state hard drives, because they were mailing petabit drives from Boston to Palo Alto and back. And we made some good money on that tangential investment. But now it's we're turning biology to bits, and it's a big data problem.
Where does AI fit in? It's something that's obviously soaking up like 80% of the VC dollars. It's obviously a lot of hype. Is this something that's tentacles kind of making its way into the biotech world? Is there any excitement about AI as a, potential accelerants to drug development? Or is this still a 10, 15-year problem? It's just going to generate more leads?
The answer to everything that you just said is yes. It's an accelerant. It's not a panacea. Of course, we're excited about it, but I've also been hearing about AI for 5 or 10 years in the space. At the end of the day, you still need to run the trials and show that they work in man. And they're just the gold standard of a double-blind, placebo-controlled trial is not going away anytime soon. There are some nuances. Right to try is a thing. We're being a little more thoughtful about, look, if it's safe and we think it works, let's start giving it to patients, but continue to monitor them and collect data. Initial benefit for AI is going to be in drug screening and molecule creation, and a bit of have you thought of this? And then that's on the front end. In the middle, it will have some benefits in trial design and trial execution. And what I mean by that is, it used to be that big pharma was not interested in finding the 10% of patients that their drug worked in, because the other 90% would stop using their drug. Like, what's the goal? Why am I going to drop my, if I can I'd rather give my pill to all the patients and then it works in the 10% rather than just that 10%. Where the market is headed and regulatory environment is headed and has been working towards, like, no, let's just look at these specific drugs, and they put financial incentives in. Let's just, what is the subset of patients it works in, and let's just study it in them and let's give it to them. AI is going to be helpful in identifying those subsets of patients. So in theory, a trial that had 70% chance of success without AI will have a 77% chance of success with AI because you're getting the right patients in and you're keeping the wrong patients out. The problem is that every one of these trials is an N of 1. It's a 2 to 4 year cycle. So it's not like you get a lot. Like, what really is the difference between a 70% chance and a 77% chance of success when you only get one shot? Throughout my career, I would handicap things at 80% and they would work, and then you get an attaboy and you're like, all right, but was my work right? It might have been 20% chance to win, and I just caught a good card. And on the flip side, something was 30% chance to work and it didn't, or it did. And you just don't get enough reps in a large enough data set, which is also what makes it just a forever, continually interesting and fascinating space for me to invest in. Because I love that.
And it's optimistic, I mean, I think spending time studying some ad company that's optimizing ads is a little less exciting than, getting to spend time on life-changing ideas. Regulatory obviously plays a role with kind of going on with drug pricing. I feel like it's always in the news. I imagine that mostly affects the downriver sort of larger caps products with sales currently. What any general thoughts?
Yes. So there are two major things that are going on as far as regulatory uncertainty, and the markets obviously hate uncertainty. And again, biotech is the tip of the tail. So any uncertainty that shocks that biotech feels them more than others. And the two primary issues are the Inflation Reduction Act, IRA, going back to Biden's administration. And that was changing the rules on IP duration. Our friend in our example of the large pharma CFO who's willing to pay 5 times peak sales, he's only doing that if he knows he's going to get 10 years of sales out of the product. Once you start to change those rules, the calculus changes. So that is part of the reason that M&A stopped, is that, we don't know if we're going to get our money back on these things, and we don't want to be the ones who just paid up and are caught, paying for yesterday's rules when they've just changed. The other that's more current is Trump talking about most favored nation pricing. And essentially what that means, and I'll bring it up to speed pretty quickly here, but drugs are developed for the US market. I just learned at that Kabaya retreat, we have content, and one of the speakers was on pricing, and they said that when they used to do their calculus on the value of a drug, the US was like 50% of the total value. Today, it's 80%. And that's primarily because prices have increased in the US and they have not increased elsewhere. But from a game theory standpoint, if you're developing a drug, the 99% gross margin product for the US, and you make all of the math work on the US, then if you can sell it in a discrete market, a segmented market, you could sell it for anything and make money, because it's a 99% gross margin product at this point. And it's not able to be, if you remember from Hillary, we talked about drug reimportation. This is why some of us would get our medicine from Canada and wherever we would go seek things out. Or when I'd be in India, for work, I'd bring some medicines back for me and my family. What Trump is saying is, look, whatever you are charging, for the lowest price in the world, we're going to get here. And that is incredibly disruptive. You saw Pfizer just cut a deal to try to solve some of this. What I think is interesting about that, well, there's two things that go on. The immediate reaction, if 80% of the value is the US, and you're talking about that, you don't want the tail to wag the dog. So if that 20% could ruin my 80%, I just won't launch products outside of the US. That's easy. That's going to happen. So now there's going to have to be some level of negotiation from other countries and whatnot. The other thing that's very interesting and is getting this M&A wheel going again, the flywheel going again, is that it's the products that are developed during this period of uncertainty. Those are the ones that are going to be affected. Once this is all sorted out, these other assets, you're going to be able to, you're just going to come up with the most rational price in the most rational geographic areas to launch these drugs. So it will get sorted, and the uncertainty will abate, and the multiples will return, and the conveyor belt, again, to continue that analogy, will continue to hum. What's interesting for me, sitting on the therapeutic side, is we hear about drug prices. So, on a headline, and it's because it's easy to run for Congress on lower drug prices for your sick babies and your sick parents. What share of healthcare spend in the U.S. is pharmaceuticals, do you think?
I was going to say 20%.
You did not get it within 10%. It's 9.
9. I was going to say 10, and then I was like, there's no way that's right. And I was trying to think of once I said 20, I was like, oh no, it's going to be like 80. Because I was like, what do we, then I was like, oh no, a lot of hospital, a lot of late life care.
Yeah. It's like 40% of healthcare spend is on end of life care. It's I understand why it happens, but it's crazy. But I was having a conversation with one of our friends just last week, and we were discussing this, and like pharmaceuticals are part of the solution. Like let's just think about obesity and the GLP-1s and all, just from a mortality benefit and what we're spending on them. They are part of the solution. And I was looking at the healthcare administration. I forget what the number was, but it was the estimate, when you distilled it down, the estimate of just redundancy and inefficiencies in hospital administration is 9% of healthcare spend. So that if we just focused on efficiencies, we could have all of our drugs for free. And so they're not going to stifle innovation. They're going to figure out the uncertainty. The rest of the world, 80% is not fair. I understand how we got there. And there will be some negotiations to get some of the other countries to start picking up some of the R&D dollars. But in the meantime, as you mentioned, there are 350, 400 public biopharma companies, over $100 million. There's wait until if this market continues to return or rebound, wait until you see the rebalances in these benchmarks come next year. And the folks who think they can, this is when the flywheel starts happening. They think they can ignore, and as I showed that slide where the folks are 20 to 50% underweight therapeutics, you have been right for the last 3 years. That is started to change. It's up in the last 6 to 9 months. I thought it was beating the S&P, and biotech's beating all of healthcare. And this game with the market cap, there are just so many companies that are still public, and there was so much dilution that was done over the last 2 or 3 years that I look at these guys. I've gotten back into investing after I took 2 months off, and Jen and I went to Scotland, and then I got back here, and I started waking up earlier and earlier and putting my PA to work, and I've been getting back involved in revisiting companies. And I see some of these companies and I'm like, wait, that $4 stock is $1 billion market cap. And it's because they've had to do these dilutive raises to stay alive. That aggregate market cap and these companies that are either shifting from value to growth, which is just cheap to expensive, and the breadth of this lift, the peak weight in the Russell 2000 growth was about 24% during that 2020, 2021 period. This is by weight. I think currently it's in the 10 to 12% level. that is coming back. And then you're going to start this whole cycle of reluctant investors who are going to start with the top of the benchmark and go own, don't own, own, don't own, own, don't own, and just okay, I just need to own the, the top 30 names in the benchmark, and it's you cannot solve this space without active management. You cannot solve this space without duration.
Next time we have you on, we're going to force you to do some picks. Is shorting a minefield in biotech? I know people that'll do it, but it's pretty tough.
I mean, the right way to do it is to short ETFs, and the banks will put together baskets for you. But you're already running with I run with 40 to 80 names, and then if you have 2 shorts for every long, like these aren't you're fading themes, you're fading, and there just aren't enough companies. And then just with the asymmetric outcomes, the shorting is I've been doing the individual name shorting because I can. I've never been able to, and I'm enjoying it. I'm doing it also just to build up my skill set. A hedge fund is in the realm of likely landing spots for me. And there is this, I think, unfounded bias against folks who have not shorted individual stocks versus, when you're managing to a benchmark, you are long short. If the benchmark owns something and I don't, I am short it. The difference is that I cannot press a short. So the right way to think about this is the game theory. This is when once you introduce a benchmark, you are no longer investing, you're solving for a game. And this goes back to when I was at TIA-CREF. We had these sector neutral portfolios. And so we would do big pharma. We had our own pool of like $500 million that we would manage it in big pharma. There were 5 names, maybe 6. Pfizer was half of the benchmark. So the first thing you would do, this is just a decision tree. Your first decision was Pfizer, not Pfizer. Like Silicon Valley, hot dog, not hot dog. Pfizer, not Pfizer. And if you thought that Pfizer was the best name out of those 5 or 6, your job was done, because the most you could get is 50% tracking error. And if it wasn't, then you went short Pfizer and you went to the next one, which was like Bristol or Schering-Plough back then, or Wyeth. And you just went systematically down there and you figured out what your portfolio would be. Now, enter the Russell 2000 growth benchmark. It gets rebalanced May or June every year. We start to get the information in May, and then in June, in one day, you get this big shuffle. And the rational way to go about it is you are dealt I love my poker analogies. You are dealt a hand of shorts. And your decision is, will I cover that short and go long? Or will I accept the exposure to it? The problem is that you can find the best short in the world, but if the bench only owns 5 bits of it, you can't, and you're running with 70 bit positions, or you can't come up with enough of these, and you can't press them, that you are just really handcuffed. Relative to being able to come up with your own bespoke short basket and then bet against it. You basically, what the shorts are, yes, many of them are generating alpha out of their shorts. And if they're doing it in biotech with the asymmetric outcomes, God bless them. But really what a lot of them are doing are creating their own custom benchmarks to then judge their long portfolio against. And it's a source of capital. I don't need that name to go down. I just need it to go up less than, what I put that money into.
What's a recent example here?
I'll give you a real-time one. This is just a couple weeks ago. It's a company called Moon Lake. It was a SPAC. They're basically looking at a longer-acting, safer version of existing immunology drugs. And it was widely owned. It's about a $4 billion name. And data were coming out in September, end of the quarter. And the data came out on a weekend, on a Sunday, and they were murky. Judged against the placebo, the absolute rate of resolution or improvement in this disease, first of many diseases that they're studying, absolute level was actually kind of fine. But from a placebo adjusted, you give the placebo to the control arm. How did they do? When you do active minus control. The one was statistically significant but underwhelming effect, certainly relative to other drugs that are approved. And the other of the two trials that read out actually was not statistically significant. Stock traded immediately to cash, which was down 90+%. And I'm sitting here now as just, armchair shade tree investor, freedom to operate, which I love. And I'm seeing this setup, and I know how widely it's owned. And this is going right into the end of the quarter. It's amazing when you think about this long duration money and how much calendar effect comes into play. That if something, a delay shifts from November to February and a trial reading out, that does not impact the MPV of the asset by very much. But to Joe hedge fund manager who needs to make his number, that matters. So this was going right into the end of the quarter. And I see this setup and I'm like, oh man, this is going to be, all time. And you can bring up the stock chart. It's MLTX. You're going to have to squint your eyes when you see what happened afterwards. But because this was, this is going to be a get it off my books trade because the PMs just don't want to show this in their holdings that they lost money. And even though they're going to have to, if it was meaningful enough, they're going to have to put it in their, they're going to have to report it in their commentaries. But, just the all-time, at a minimum, a dead cat bounce is coming. But at a maximum, there's a path forward for this drug. And sure enough, you could have bought it September 29th and 30th with a 6 handle on it. And it got above $10. And now it's starting to find its way. But KOLs, folks who are just trying to develop medicines and treat their patients said, this is a quote at one of the conferences I was at, it was that folks on Wall Street are the only people who care about placebo-adjusted results. And I understand why. You should be comparing this to a sugar pill. But we don't care about that. We care about treating patients. And this drug is going to get approved. And it's going to be standard of care in these patients. That was her opinion. That is not, fact. But not only should it not, went from 60 to 6, not only should it not be if it's got a path forward, if it gets approved, not only should it be at 60, but something like that should be, obviously it was not pricing in approval, weighing on phase 3 data. And, these are the opportunities that we are presented with on the regular in this space. It is just such a fascinating space to invest in.
Chris, most memorable investment, good, bad, in between?
Yeah, I'll tell you a good one. There are a lot of bad ones as well. So back 15 years ago, when we really started to pivot and go from these risk averse to investing what I think was optimally and correctly in the biotech market, there was a story called a company called Pharmaset. And Pharmaset was trying to develop a product for hepatitis C. And hepatitis C, for those of you who don't know, it's a baby boomer disease. I call it, it's drug, sex, and blood transfusions. And it lies more or less dormant in your body for 20 or 25 years. And then all of a sudden it starts to affect your liver and you get cirrhosis and you die of liver failure. So you have time. It's a very unique space where you can find out if you got hep C today, you have time. So there were all these patients who were waiting and warehoused, waiting for the next best thing. And there was a product that Pharmaset was developing. The alphanumeric code was PSI 7977. And it was a nucleoside inhibitor. And I love analogies. I need analogies to think of this high science stuff. But its goal was to be used in combination with other drugs that were interrupting the replication of the DNA, that the virus would gain resistance to those drugs. Well, if you added this Pharmaset drug, it would prevent the resistance. So I thought of it as a fullback that could block for the running back that was really going to do the work and advance the ball. And they did some real smart things. They they signed these non-exclusive development partnerships where they would lend their drug out to everybody else and let them play around with it, but it was non-committal. And the CMO, her name is Michelle Berry. She's a fantastic woman. She told me we had this metric that once we get it in 400 patients, we know it works. In infectious disease is really interesting that if you know you're interrupting something from an infectious disease standpoint, you're going to know early on. It's all about whether it's safe or not. If you can get it into humans in enough of a concentration that it'll work without doing something else. So she gave us this metric of 400 patients. If once we got to 400 patients, things were happy. So that's all we were really monitoring. We knew it was going to work, and we were just monitoring when were they going to enroll 400 patients, and we kind of get the all clear. So this advanced through phase 1 into phase 2. We got our 400 patients now, so we knew it was safe. And it turned out, you remember these moments in your career. This is back when you used to go to things in person, but the AASLD, the American Association for the Study of Liver Diseases, was here in San Francisco, right down in the Moscone Center. And we're in the room and they were revealing the results. This is, if you've seen The Fugitive, it's just like the end of The Fugitive where you're all in a conference room and they're releasing the results. And they released the results, and this drug on its own had 100% cure rates over all the variations of the disease. So not only was it not the fullback that was, I thought of it as like Tom Rathman, that it was a fullback that could also run the ball itself. And throughout the auditorium, there were oohs and ahs. And these are, generally introverted people who don't shout out when they see data on the screens at a conference like this. And the stock had already moved quite a bit running into it. For some reason, the stock did not move in spite of these just perfect data. And 2 weeks later, Gilead bought the company for $11 billion. And going back to where we got in, it was a 20 bagger by market cap. I don't know if it was obviously there was a lot of dilution on the way, but I was proud of the fact that we participated in every secondary along the way, that I feel that I'm helping the company out if I invest directly with them, and I'm solving their needs, and I'm also solving my needs because I'm helping the company get further to the right on that cash runway curve that we looked at earlier. And then when I go out and talk my book and go to ideas dinners, if people want to invest, they got to go buy the shares on the open market from somebody else and drive the share price up, and not from me. So amazingly, Gilead, this is the most expensive phase 2 acquisition of all time. Gilead's stock traded down on the news of the acquisition. It was a little out of their wheelhouse, not in their HIV primarily, so it was kind of tangential. Then somebody, a friend of mine, had a bet that they were going to pay for that acquisition in the first full year on the market. And sure enough, when that drug was approved, because it was so good and so safe, and all these patients had been warehoused and were all of a sudden in need of it, that they did, I believe, $14 billion in revenue the first full year on the market. Gilead ended up, not beyond the cash, $100 billion of market cap gain, really attributed to this acquisition.
100 billion here, 100 billion there. You're talking real money.
I know. And nothing in the $1 trillion world now. And I still am wondering, so Michelle, I consider her a friend. She met her husband, who was IR for the firm. And I'm still waiting for the Disney movie about her life, that she cured a global pandemic and found love in the process.
People want to keep up to date with Chris. What's the best place to find you? Is it LinkedIn?
Yeah, I'm not a big social media guy. However, I've started to, and now that I'm free of the compliance restrictions, I've started to write a few things on LinkedIn, some of my thoughts. These are some of the things I would tell companies through testing the waters meetings over the years. I'm just kind of giving out this free advice, which is probably worth what you're paying on LinkedIn. I've been doing I left RS and Victory in May. I've been doing some consulting here and there for some of these smaller companies that need help thinking about a path forward, some of the things that I spoke about on the pod today. And then, I've been thinking about where I can get back involved in the biotech ecosystem at a point in my career where I want to affect meaningful change. I do see this as a generational opportunity that's not just for investors, that's for operators as well. So I would bet, I am a betting man, I would bet that I resurface in one of two capacities. One is in an operating role, helping one of these exciting biotechs navigate the waters in dealing with folks like me and my brethren on the other side. And the other is managing a pool of capital that is excited and interested in investing in these types of companies and is not a reluctant investor, but a real active, long duration biotech investor that wants to solve that wide gulf between the private money that we spoke about and the generalist money, that has really withdrawn from the market.
You got an email address people can find yet?
Yeah. cwclarkbio@gmail.com.
Perfect. Chris, it's been a whirlwind tour. Thank you so much for joining us today.
Thanks, Matt. Years in the making, and I really appreciate you having me on.
Podcast listeners will post show notes to today's conversation at mebfaber.com/podcast. If you love the show, if you hate it, shoot us feedback at themebfabershow.com. We love to read the reviews. Please review us on iTunes and subscribe to the show anywhere good podcasts are found. Thanks for listening, friends, and good investing.